Welcome to Taking Stock. I'm Amanda Lang. Coming up in the show, how confident is the Bank of Canada in our economy? And are businesses pivoting to a post-U.S. trade reality? Plus, planning to lose your top talent takes a plan. That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada held steady on interest rates this week as expected at 2.25%. With the labour market showing surprising resilience, the bank said it thinks the current level of rates will hold inflation in line. It also noted that the economy has performed better than expected but will continue to face a period of adjustment. The U.S. Central Bank went the other way this week, delivering a third rate cut in a row, while also pointing to possible signs of price pressures ahead. The Fed is balancing risks of a weak labor market against concerns that prices could begin to accelerate again. The cost of living is falling in Canada, at least for renters. Rental rates dropped in November for the 14th consecutive month to a national average of $2,074. The steepest decline was in BC, where rent fell 6.4%. Separately, Royal LePage said national home prices will rise by about 1% in 2026, but some key markets, including Toronto, will see a decline, in that case, of 4.5% by fourth quarter of next year. Print and packaging company Transcontinental said it's selling its largest division to U.S.-based Pro-Am Pack Holdings for $2.2 billion and refocusing its efforts on its domestic print and in-store marketing business. The larger packaging business had heavily facing U.S. operations. Microsoft will invest another $7.5 billion in Canada over the next 2 years to build new AI and digital infrastructure. That brings the total investment between now and 2027 to $19 billion. The money will be spent on data centers, and Microsoft said will improve Canada's protection of its own data. SpaceX reportedly plans to pursue an IPO next year that could value the firm at $1.5 trillion. A public offering that sold $30 billion worth of stock values the satellite firm at the same market price as Saudi Arabia's Aramco when it listed its shares in 2019. SpaceX is focused on its Starlink internet service, as well as the development of space rockets that could reach Mars. And those are your business briefs. Canada's central bank continues to walk a fine line, but will we get the growth they're counting on? Benjamin Tal is Deputy Chief Economist at CIBC. Thanks for being with us.
A pleasure. Thank you.
So there's such a big asterisk on everything the bank is saying because, of course, everything is better than we thought, Ben, but there's still the resolution of our trade dispute with the U.S. and getting a new deal. How do you factor that into making any kind of projections about next year?
Yes, we are basically flying blind here. There is no question about it. The fog of uncertainty is still there. It will be with us for a while. Therefore, the Bank of Canada really does not know. One thing for sure, they are basically telling you we are down for now. And there they are opening the gate to two options. One is actually to raise interest rates. The other is to cut interest rates. So you can interpret it the way you want if you're the market. They are basically telling you if something happens, we can actually raise interest rates. If something else happens, we can cut interest rates. So they really don't know. At this point, they are ready to tell you that they are not touching interest rates anytime soon. Our call is that actually interest rates will not be moving at all in 2026.
Interesting. Of course, I haven't had a chance to ask you about one of the reasons why things are better than we expected is that things were better than we thought. The revisions of several years of GDP and productivity. Ben, this is why economists get a bad name. No shade on the folks at StatsCan, but what's going on here? What do we make of the fact that we've just revised several years worth of data?
Yeah, all of a sudden we are very productive. All of a sudden the economy is booming, so things are good. Yeah, that's a little bit frustrating because you basically built a narrative and then all of a sudden it changes because the data changes. But it's better to have accurate data. It doesn't mean that we are not in a situation in which the economy is not in a slack. What I mean by that is that, yes, GDP is 1.7% higher than it was, but also potential GDP is 1.7% higher, which means that we are below potential, and that's disinflationary.
Okay, so good point. We still could be doing better. So let's come back to where we are and what the bank might think about doing. They didn't give forward projections today. We're waiting for that. Do you think it's time, and are you starting to build scenarios around no trade deal? The CUSMA gets ripped up and we have some kind of basis where there's tariffs on virtually everything that goes across the border? Or is that just such a nuclear option that you don't even want to model that out?
Yeah, I really don't want to think about it. I doubt it will be the case because my working assumption when it comes to Trump is the following. The narrative is the following. We are trying to to make sense of something that does not make sense. We're trying to normalize the abnormal. But I think there is a narrative here that goes beyond the tweets. And this narrative is time is not on his side. Clearly, the economy is not behaving. Inflation is rising. The unemployment rate in the U.S. is rising. At one point, people will say, Mr. Trump, we did not vote for that. In a year from now, he has the midterm election. What do you have to show for? And therefore, I think my working assumption here is that he will have to compromise. Doesn't mean that he will remove tariffs. They are not going to be removed. Tariffs are here to stay, but they will be lower because he has no choice. Time is not on his side, in my opinion.
So interesting. Okay, then let me finish with the thing I think people care most about, and that is what you think will happen with jobs. We had this unusual strength in the last 3 months. As you look into 2026, does that continue? Is the market sort of firmer than we thought it would be?
Yes, I think that the Bank of Canada is downplaying the improvement in the labor market, quite frankly. Rightly so. I think that the labor force survey is a random number generator, if you wish. It's very, very volatile. I do believe that we are reaching peak unemployment, which is a good thing, especially for young Canadians that are struggling. But this is not a booming economy by any stretch of the imagination.
So good to have you, Ben. Always appreciate your time.
My pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Coming up, businesses are doing what they need to do to adjust to a new trade reality, right? Stay with us. Welcome back. It's often said small businesses are the lifeblood of our economy. Well, here's what that means by the numbers. At the end of 2023, there were 1.1 million employer businesses in Canada, and 98% of them were small businesses with fewer than 100 employees. 1.5% were medium-sized. That's 16,966 businesses employing between 100 and 500 people, and just 0.3%, or about 3,400 businesses, employed more than 500 people. Small businesses tend to grow year by year. The average in the 4 years leading up to 2021 saw 103,000 new businesses added to the mix and 94,000 disappearing. At the end of 2023, small businesses employed 5.8 million people, or 46.5% of the private labor force. And of the 302,450 fixed jobs created between 2022 and 2023, small businesses accounted for 38% of them. Medium businesses accounted for 11.5%, and large firms were responsible for 47.7% of the new private sector jobs. Meanwhile, small and medium-sized firms contribute 50.8% on average to the country's GDP in goods-producing industries and 46% in service sectors. But of the total industry in Canada, the service sector dominates, accounting for 76.6% of total businesses, with 23.4% of firms engaged in goods production. One thing that seems obvious from the recent data is there's a certain amount of adjustment going on in the trade situation. So are we likely to avoid a worst-case scenario for business? Goldie Hyder is CEO of the Business Council of Canada. Goldie, thanks for being with us.
Great to be with you, Amanda.
Now, there are obviously worst-case scenarios that could come, but we've had this data, Goldie, where our economy is doing okay, not great. Business investment's still not where we want, but the jobs numbers say maybe things aren't as bad as we've seen, and then we got the revisions to the economic numbers for the last 3 years. Are businesses pivoting better than we had feared?
Well, it seems that the Canadian economy has been more resilient than we might have expected, particularly given the fact that we're in a trade war with our number one trading customer, and frankly, our number two trading customer is also punishing us when you think about what's going on in the canola industry. And yet somehow we haven't slipped into a recession. We've seen job numbers that have gone up, and we did see the revision that you referenced from Statistics Canada, albeit 3 years later, suggesting that over the course of that time, the economy was doing better than had been reported. And so if you're Governor Macklin, you might be wondering, would I have cut the rates as fast as I did? And so it's not a surprise that today's announcement about holding the rate is probably where we're going to be for a period of time. But we're not out of the woods by any stretch of the imagination. There are a lot of risks still out there.
And of course, one of the big things we need business to do is have the confidence to invest. The budget is aimed at sort of spurring some of that investment. What are you hearing about the likelihood of that happening? Until we see it in the actions of CEOs, it doesn't really mean anything that it's there on paper.
Yeah, that's the key thing here. There's a lot of there's no question there's a lot of good intentions. There's certainly some momentum that seems to be coming in terms of a federal government that seems serious about both building the infrastructure that's necessary to diversify and to attract the capital, because we have written just prior to the budget that Canada is in an investment crisis, that we're simply not getting the investment that we need to be able to scale up. We here at the Business Council, on behalf of our members really are looking at three things. How do we stabilize the relationship with the United States of America, which has to be done, and I believe inevitably will be done, but it's the waiting that is taking its toll on the economy and the confidence that you reference. Secondly, and arguably more importantly, how do we strengthen Canada? How do we fix it? How do we get out of our own way when it comes to interprovincial trade barriers, the issues about building trade-enabling infrastructure so that we can diversify? Because when I travel abroad, and I've done a few of those trips even with the Prime Minister, he hears what I hear, which is we like what you're saying. We want to invest in Canada. There's a bit of a show me, not just tell me mode, but they also ask very subtly, sometimes more directly, depending on which country you're in, how's it going on the review and renewal of the USMCA? So all of these three things connect if we're going to be coming out of this stronger and more independent and sovereign, which is what Canadians are expecting this government to deliver.
Best case scenario, Goldie, is that we, on the other side of a renegotiation, have a deal that's not dissimilar to the one we have, where we have 0 to very low tariffs on most of our goods. Even if some of our integrated industries change a little bit, as they probably will, are businesses prepared for anything else? Have we started doing the kind of planning scenarios of what if there is a difference, more of like a UK-style deal of 10% tariffs?
I think what you're looking at here is businesses are saying we need the right indications and signals that eventually there is going to be a review and renewal. And I wouldn't use the word renegotiation because we just negotiated it a matter of 5 years ago. The ink's barely dry. Right. This clause is there. We all agreed to it. The goal is to review and renew. And last week I was presenting at the USTR, who's engaged in a 270-day process to come up with their recommendations to their own government as we get ready to sit down, 3 countries, next year and find a way forward on what should be issues that are about trade. They're not about other things. They're about trade issues. And I think that there is reason to be optimistic. The only issue I have, Amanda, from everything I see and hear in the United States is when. How long will it take? Because the more uncertainty is of benefit to America, they will attract the capital. And we need to make sure any agreement is trilateral and nothing else.
Goldie, so good to have you for this. Appreciate your time.
Thanks for having me.
Goldie Hyder is CEO of the Business Council of Canada. Medium to large businesses do have some advantages in hard times, including access to the capital they need to find new markets. So how is one Canadian cosmetics firm handling it? David Cape is president of Groupe Marcel. Thanks for being with us, David.
It's my pleasure, Amanda. Great to be with you today.
And I really did want to start with, I mean, you're a successful Montreal-based player in a pretty big space. How have you been experiencing the economy and the effects of a trade war?
Well, you know, the trade war brought great disruption to the marketplace. And as the largest Canadian cosmetics manufacturer, we were very well placed to use the opportunity to reconnect again with our Canadian consumers. And it was really terrific for us to see how excited Canadian women were to engage with us because our products are made in Canada, manufactured here in our Montreal facility. And they really took great pride in using some for the first time, some re-engaging with our Canadian products. So we've been growing above the market, and it's really been an exciting period for us.
Yeah, I mean, you get it in both the buy Canadian mentality, but also because you manufacture, right? We're really looking for more of that in this country. Would you expect your growth to come domestically, or is there still international growth to be had for you?
We've always been incredibly strong in Quebec. And we've also been strong in English Canada, but we've been working to increase our presence even more in English Canada over the last number of years. So the last year was really a fortuitous time for us to really build awareness of our brands. Some women really were not aware that our products were Canadian, were manufactured in Montreal. So allowing us to kind of communicate that proudly Canadian message and to let everyone know that we manufacture our products here was really a terrific opportunity.
What about your supply chains, David? Have you felt any interruption or disruption because of everything that's going on in terms of maybe just the cost or just access to products?
Sure. There was a period when the counter tariffs were in place that we had to look at some of our supplies and kind of decide whether we were going to ride that out or look at other alternatives. We really do source ingredients and components from around the world, from Europe, from Asia, and from the United States. But that did stabilize. And really, you know, once we'd been through COVID, everything else seemed to be a lot easier for us.
You're a reasonably big employer. The jobs picture has been so interesting because we expected it to be terrible. It's been better than many thought. What's your perspective on kind of what you need, what you see in the year ahead? Will you be hiring? Will you be stable?
we think we're going to be stable to hiring. We're looking for growth. It's a very exciting week. We just opened our new office facility in Montreal, where we've expanded and brought together 180 of our workers, our marketing teams, our innovation teams. We really do it all here in Montreal, and we've brought them all together in one facility. So it's really a good time in the market. But of course, we want to make sure that we have access to great human resources in the future. It's really an exciting industry to be working in, and so we really reach out into the community and let people know that there's this great opportunity to work for a cosmetics manufacturer that innovates here in Canada.
And I guess I should ask, I mean, it sounds as though you were well positioned, but in some ways this has been beneficial to you because you are Canadian and you make Canadian, but a slowdown is not good for anyone. Would you say to other businesses to be confident? Do you feel confident about the year ahead?
I feel for, some people who've seen, the world change in front of their eyes and their costs go up tremendously. I've been in business for 30 years, and we're a family business that's been here for 76 years. And my father's always taught me about the long term. Mm-hmm. I would say that, of course, things are going to change, and I hope things will improve over time. It's great to see people really looking for new ways of doing business and new opportunities for expanding exports in different directions. So we learned that we have to be resilient. It's really important for business.
So good to have you for this, David. Appreciate your time today.
Thank you, Amanda. It's great speaking with you.
David Cape is the president of Groupe Marcel. Coming up, as our workforce ages or is retired early, how do we ensure that that knowledge doesn't go with them? That's next. Welcome back. Thousands of civil servants in Ottawa are being offered early retirement. Elsewhere, an aging workforce means that every year business knowledge and experience disappears, but maybe there's a way to hang on to that. Brian Monette is CEO at Transition Path. Thanks for being with us, Brian.
Nice to see you again.
So this is a big issue. It was an issue before we see these, thousands and thousands of layoffs in the civil service. We have an aging workforce, Brian. Your business is aimed at kind of capturing knowledge. Elevator pitch on how that works. How do you make sure that your aging employees who have all the experience and wisdom don't just take it to the golf course with them?
Absolutely. Yeah, it's a complicated issue primarily because it's evidenced by Canada's productivity challenges that we're seeing. It's measured against us and the rest of the G7. So Transition Path developed methods to capture and organize what these experts do and to codify it so that organizations can retain and preserve that knowledge and use that for the basis of recruiting and onboarding successors. We've been at it for since 2010, and at the beginning it was the most complicated roles that navigated to Transition Path, those that take many decades to become proficient and to become compliant to doing this work.
I can imagine now, Brian, that companies that might not even have thought of this before, although they probably should have because of demographics, are thinking about it because of AI. We need to actually communicate to software engineers what our business processes are. A lot of that knowledge and the kind of, it's sort of the wisdom and experience, you can't really write it in a manual sometimes. Can you help businesses do that, actually translate this into kind of a new way of doing business?
Yeah, that's the evolution of our company as well. Artificial intelligence requires institutional knowledge as feedstock that AI can use, but we need to make certain that the information we provide to AI is in fact certified, it's approved, and it's the most accurate reflection of the work that's at hand. But also what we find is that when we're working across the entire stack of employees, from developers to software engineers to engineers and scientists, often we miss the workarounds. These are things that people do independently of their job, and they're often not well documented by other people. But when they leave, that creates significant problems, and we see that in the productivity numbers.
I have to ask you, I think I've known about your business. I think I first talked to you about 13 years ago. But do you do a lot of business in Canada? Is this something that non-Canadian execs sort of get better than Canadian execs? Or what's the sort of level of awareness of the need for this?
Yeah, it's a great question. I really appreciate you asking it. What we're finding is that our business in the U.S. is growing much faster, primarily because of just the number of industry players in the United States, predominantly in nuclear power, aviation, and the defense areas, where they have a significant aging problem as well. And they have much more consistent long-term expenditures. And that's really where clients can look at transition path for perhaps 60-month periods where they're really trying to get gather all of this data so that they can predict and look out further, beyond the next 60 months. In our view of the world, the next 60 months will be a profound challenge for Canada, primarily because all of those baby boomers who happen to be at the highest level of their productivity will be gone in the next 60 months. And so that happens to be the knowledge that AI needs. And so codifying that in Canada is going to be absolutely essential. We read in the newspaper every single day that Canada needs to expand our borders, which means we need to find productivity gains to cover the cost of shipping products further into other parts of the world that would previously been shipped on a truck to the United States. It's
important, Brian. So good to talk to you. Appreciate your time for this.
Thank you. Have a great day.
Brian Manette is CEO at Transition Path. Time for the takeaway, and coming second in a winner-takes-all race. This week, Canada and its European allies made a show of cooperation around artificial intelligence. And given how both are working hard to develop a thriving AI industry, why not? But however well-intentioned, it felt a little like a sideshow. While Canada talks up its early lead in AI, we can claim to have given birth to it because some of its inventors are Canadians. We can't do much to compete with the power and might of the U.S. tech companies, which already have it firmly in their grasp. What we could do, and what an alliance with our European allies might help do, is create and enforce rules around how AI will be developed and deployed. Some of those very founding fathers are the ones sounding the alarm about too few controls or thought being given to how this planet-changing technology is being unleashed. And in case we needed a reminder that we're on our own, this week the U.S. president said he believes in moving fast and regulating lightly when it comes to AI. To that end, he said he will sign an executive order blocking state-level regulations of AI so that only federal regs apply, allowing tech firms to move faster. The obvious problem with that rush to develop without regulations is that the harm that could be done by the technology is left to unfold in real time, and repercussions addressed only after they emerge. In the current vacuum of regulation, some U.S. states have imposed rules around things like deepfakes or other harmful or risky uses as they emerge. Tech CEOs complained that a patchwork of state-level rules was slowing them down. Now the president agrees and will smooth the path to, well, we'll find out. So where does that leave the do-gooders in Canada and the EU? Probably not at the front of the race, but let's not assume we're relegated to spectator status either. We can and should be talking about global agreements on AI regulation and imposing them at our border. Our sovereignty and our future industry might depend on it. My takeaway? Tech bros talk about moving fast and breaking things. Sounds great until we are the thing being broken. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.